A very warm welcome to our learners, our beloved students who are about to exit their professional accountancy studies, and you are faced with advanced financial reporting, strategic business reporter, as the case might be. I'd like to discuss financial instruments from the introduction point of view, as an introductory session. And I've done some video discussive video lecture on this particular topic. I think today I want to focus on the illustrations and the assignments that would help us to explain this very important topic of financial instruments. And I thought I'd start from here. Why financial instruments? Why financial instruments? Now we might be aware that financial markets use complex financial securities which normally have material effects on the financial statements. There is need for guidance and standards in this particular area of accounting to promote consistency, and you're talking about three standards. You have got IFRS 7, IFRS 9, and IAS 32. And as we go through the questions, I'll try by all means to make reference to those international financial reporting standards. This financial instruments topic seeks to minimize also off-balance sheet treatment of financial securities. So I'm going to go straight to the illustrations and the questions, in the hope, of course, that our lecture will not be boring. And we have got an illustration one there, and it's a revision from the previous class of financial reporting. For it is assumed in our class that what we do here, we are building up on financial reporting. I'll start with classification, and of course our first discussion is on redeemable preference shares treatment. From company accounts and of course financial reporting, we know that redeemable preference shares have got a repayment date, and that's the reason why they are redeemable. Many entities issue preference shares which must be redeemed by the issuer for a fixed amount at a fixed future date. In such cases, the issuer has a contractual obligation to deliver cash, and therefore the instrument is to be treated as a financial liability and should be classified as a liability in the statement of financial position. So preference shares should be treated, redeemable preference shares for that matter, should be treated as financial liabilities, and the dividends paid thereon is supposed to be treated as a finance cost. I'd like to proceed. We're still under classification and we're still under revisions. Of course, brought forward knowledge from the previous study paper AFR. Now we're going to compound instruments, and we have got a case before us. We are told KSA issues 1,000 convertible bonds, that is on 1st January 20X1 at par. Each bond is redeemable in 3 years' time at its par value of 2,000 per bond. Alternatively, each bond can be converted at the maturity date into 125 $1 shares. The bonds pay interest annually in arrears at an interest rate based on nominal value of 6%. The prevailing market interest rate for 3-year bonds that have no right of conversion is 9%. You are supposed to show the presentation of the compound instrument in the financial statements at inception. That is 3-year discount factor. Okay, we have got those numbers there. We've got 6%, 9%, and we've got the cumulative discount factors. And this again is carry forward knowledge from previous class, but somebody might say that it's been a long time. And that's the reason why we are here, to help to remind us. So a convertible loan is a hybrid loan. It is one that has got characteristics of both debt and equity, and it is a requirement under classification. Again, we started with IS 32. It's a requirement that we should do what is known as split accounting for this particular instrument. The instrument requires us to pay 6% interest, but if we got a similar loan without conversion rights, would have been paying about 9%. Why are we paying less for that matter? The lower the risk, the lower the return. In this case, this is perhaps a very comparing point under the differences in percentages. So under split accounting, and I'm going to go to the discussion points just now. I guess I've done the introduction already, but this is a question that we have before us. It discusses the issue of compound instruments. You're supposed to show the presentation of the compound instrument in the financial statements at inception. I'd like to submit again, this question speaks to the classification of financial instruments and is a revision item from the AFR class. So the convertible bonds in this case qualify to be treated as compound instruments, and the bonds should be split into equity and liability component, what we call equity accounting. So the equity component of that bond is that number, and the non-current liability component is that number. You want to counter check my work, use your calculator so that we can be on the same page. So what essentially has happened here is that we are dealing with this particular split accounting at inception. We're supposed to find the present value of the principal of this loan, which is about 2 million. So you multiply the number of loan notes 1,000 by 2, 1,000 each, and then you do the discounting over 3 years, if I'm not mistaken. Let me just get back to that point. 3-year bonds, yes, and of course we are going to discount the principal using the year 3 discount factor, and I hope that you can see there the year 3 discount factor is given, and we have got the present value of the interest also on this particular instrument, which will be given at nominal value, that is 6% of 2 million. But this time around we're going to have to use the annuity factor for the lower percentage for year 3. And if I get back to my question, I'm getting should we use the annuity factor for the lower percentage? No, but the annuity factor for the higher percentage, which is 2.531. I hope you can see that number there. Okay, so we get back, and when we do that, we find a number there, 303,720. When we add the 2, we get what we call the debt component of this particular compound instrument. So the debt component should be treated as a non-current liability, and for us to find the equity component, we simply say the proceeds received, which is 2 million, less the debt component of 1.847720, and we get that number. And so this is how we were supposed to approach this particular question. Would you allow me to proceed to the next illustration, which deals with treasury shares? Now, an entity may acquire its own shares or buy out some shareholders in a bid perhaps to reduce the cost of investment on shares. An entity acquired 10,000 of its own shares, which had previously been issued at $1.50 cents each, and they acquired these shares at $1.80 each. The entity is undecided as to how or as to whether to cancel the shares or reissue them at a later date. You're supposed to discuss how to treat this particular treasury shares in the financial statements, and I think I didn't include that in my discussion points. Let me just go there and create some space. We are told to discuss. Okay, let me just do that. Discuss. Okay, and this is treasury shares. Okay, illustration 2, treasury shares, illustration 2. Yes. Right, so there you go. You've got the discussion of treasury shares. Okay, I guess I've already read the requirement. Now we need to go to the discussion point, and for the sake of corrections, I will be enlarging some of these things so that students can see clearly here. Okay, so treasury shares should be ideally deducted from equity. That is your debit equity and your credit bank, or even another asset if you're going to use another asset to settle this payment. If the shares are cancelled, then we shall see 1.5 is to be debit allocated to share capital. Share capital gets $1 and share premium gets 0.5. The excess, since the shares were sold at $1.80, the excess of $0.3 should be recognized in the retained earnings rather than the statement of profit or loss, as the above transaction relates to the members. So I guess we are safe there. The statements would look as follows. Of course, apart from what you do in the bank, share capital comes first, share premium, and then the treasury shares will come in as a deduction of about $18,000. So I guess that is clear, and I guess that is helpful. Treasury shares is a deduction in equity. You want to ask some questions on that, and you're most welcome. I would like to proceed to the next discussive or computation part of this. We have got what we call executory contract. We're going to discuss the issue of hedging, perhaps in the next in the next few minutes. But allow me to talk about an executory contract. Is one where commitment has already been done and it cannot be reversed. We have been given an illustration there. A forward contract to purchase cocoa beans for use in making chocolate is an executory contract which is outside the scope of IFRS 9. The purchase is not accounted for until the cocoa beans is actually delivered. There is also another assignment regarding the issue of derecognition of financial instruments. So we go straight to derecognition because recognition is a little bit familiar to handle or quite easy to deal with. But allow me to discuss derecognition. A financial instrument is supposed to be derecognized when an entity is no longer party to the provisions thereof. All right, and we've got a discussive question here. It says, discuss whether the following financial instruments would be derecognized. I'll start with case A, which says AB sells an investment in shares but retains a call option to repurchase those shares at any time at a price equal to their current market value at the date of repurchase. Retains an option rather than an obligation. Is there need to derecognize these financial instruments? And I guess the answer is yes. Discuss whether the following financial instruments will be derecognized. We are discussing case A. So in case A, AB should derecognize the asset as it has the option rather than the obligation to buy the shares. What about in case B? We are told in case B, EF enters into an agreement, okay, into an agreement. I think the English there is supposed to be clear. Where an investment is lent to a third party for a fixed period of time for a fee. At the end of the period of time, the investment is returned to EF. It appears as if risks and rewards here have not passed on to the third party, and so derecognition may not be appropriate. So in case B, EF should not derecognize the asset, as it still holds majority risks and rewards of the investment in question. The stock should be retained in the books of the company even if legal rights have been passed on to a third party. Okay, so you want to be asking questions as I send this particular, lectures to you. Financial instruments, as I said earlier on, this is a discussive, is a discussive session, an introductory session, ideally meant to settle us in this discussion or topic of financial instruments. Allow me to proceed to the next question, and the next question deals with the issue of measurement. I wanted to say already that measurement is a highly examinable component of financial, instruments. Allow me to go to the question, and the question says, show the amortized cost of the loan notes from 1st January to 1st January 2023 to 31st December 20x5. You're dealing with about 3 years, not 5 years, but 3 years, and you want to read also, the question there, so that we're on the same page. Okay. Maybe before we go to that particular question, there is a simple illustration here that we can discuss. It says fair value of a debt on initial recognition. Fair value of a debt on initial recognition. So imagine a $5,000 3-year interest-free loan is made to a director. If the market interest charged on a similar loan would be, say, 4%. The fair value of the loan at inception, in this case, would be the discounted value of the 5,000, which will be, that fraction multiplied by 5,000 gives us $445, and the loan is recorded at that amount. Please remember that simpler method of doing the discount is to if I can put a simpler method here, is to say 1.04 to the power, and I hope I'll not miss my minus 3. If you want, you can try it, and that will still give you the same number, and this still give you the same number here. Okay, so now allow me to proceed to the amortized illustration. We are told a company purchases loan notes, an investment in debt, 100,000 for 96,394. You buy at a discount, and you incur transaction cost of 350. So under financial assets, transaction costs must be added, ideally added by default. The loan notes carry interest paid per year on 31st December of 4%. 4%, of course, meaning 4% of 100 is 4,000. The loan notes will be redeemed at par on 31st December 2025. The effective interest rates, that is when you get the interest rate and the transaction costs combined, you'll be paying about 5.2%. You are required to show the amortized cost. Again, I get back to my discussion there. You are required to show the amortized cost of the loan notes within the 3 years. So we just have to come up with a table, just like the way we used to do, and lease says under the old standard IS 17. Just ensure, of course, that you add back the transaction cost to the discounted or to the to the amount that you're buying, you know, this particular loan at. That's where you start from. So you're going to have that number 96,744. You add the effective interest rate. You can counter check me. It gives us something like 5031, and then you less the amount paid, the nominal interest rate, you get that number. So that at the end of this particular 3 years, I think I need to add another 0 here. At the end of this particular 3 years, I'm going to have and please bear with me, there's noise in the background. You're going to have a $100,000 in your bank account. Okay, you're going to have that in your bank account. Come in, please. Right, so essentially that's how you're supposed to work out that one. And if you'd allow me to proceed to the next part of our discussion, and that is measurement of financial assets. We've got this requirement here, and I think there are about 2 of them. And allow me to go to the question itself. It says, discuss with suitable calculations how the above financial instruments should be accounted for in the financial statements of Wharton for the year ended 31st December 20X1. I'm going to start with the first part of our question. It says, Wharton, a public limited company, has requested your advice on accounting for the following financial instruments financial instrument transactions. The first one says, on 1st January X1, Wharton made a 10,000 interest-free loan to an employee to be paid back on 31st December 20X2. The market rate on an equivalent loan would be 5%. So I guess you can see this is a 2-year loan, and we need to discuss the measurement. This is again a financial asset to the company, but to the director, of course, it is a liability. Okay, so we have to get on to that one. Again, the question says, discuss with suitable calculations how the above financial instruments should be accounted for in the financial statements of Wharton. So for the interest-free loan, this is an investment in debt where the business model is to collect contractual cash flows. Such investments are normally measured at fair value through the profit or loss. I may need to send you some notes so that you can understand the measurement basis for all these items. But allow me to go to the calculations and further explanations. Since we have an interest-free loan, the cash paid will not be equal to the initial fair value of the loan. The initial fair value of the loan should be discounted at market rate as given below. So you're going to have to discount, as I said earlier on, your loan at that given rate. You get 90/70. The loan is subsequently, this is initial recognition or measurement, and then we go to subsequent measurement. We are going to have to start from the same 90/70, add the effective interest rate at 5%, and since this is an interest-free loan, there is no need for us to deduct any amount, so that at the end of the day, closing balance for this particular loan will be 95.24. I hope you can see that. So we need to recognize interest income on this loan of 454 in the SBR, and the 9524 is a current financial asset to be recognized in the financial position. Great. Allow me to go to the next part of this question. Discusses again the need for us to measure financial assets. We are told Wharton anticipates capital expenditure in a few years, and so invest its excess cash in short and long-term financial assets so it can fund the expenditure when the need arises. So it can fund or finance rather the expenditure when need arises. Wharton will hold these assets to collect the contractual cash flows, and when an opportunity arises, the entity will sell financial assets to invest the cash in financial assets with a higher return. The managers responsible for this portfolio are remunerated on the overall return generated by the portfolio. And as part of this policy, Wharton purchased 50,000 per value of loan notes at 10% discount on their issue on 1st January X1. The redemption date of these loan notes is 31st December X4. Okay, X1, X3, X1, X2, X3, X4. That's about 4 years. An interest coupon of about 3% per annum the value is paid annually on 31st December. Transaction costs in this case were 450, and these were incurred on the purchase. The annual internal rate of interest on the loan notes is 5.6% at 31st December. Due to a decrease in market interest rates, the fair value of these loan notes increased to about 51,000. Great. So we proceed to the discussion points, and we are in case B now. The loan notes in question are an investment in debt instruments where the business model, as we read, is to collect contractual cash flows and to sell the financial asset within the 4 years perhaps. The asset is to be initially measured at fair value plus any transaction costs. Remember, 50,000, 90% of that is what we expect to get, plus any issue costs. Okay, plus any issue cost. Remember, say Wharton purchased 50% of the loan notes at a 10% discount, meaning that you're not going to pay everything. You're supposed to only to pay 90%. Okay, so that's, I hope that's clear. We proceed to the next part. Under the computation, so again, initially we recognize the financial instruments at 45,450, add back the effective interest rates, which is the annual at the effective internal rate of return. We have got 3% of 50,000, not 3% of 50,000, but 5.6% of 45,450. We got that number, and then 3% of 50,000 we less. All right. Now at the end of the year, we are told that there was a gain in the value of this particular financial assets due to a drop in interest rates, such that now the value of this instrument is 51,000. So there's a gain of about 45,05. Now you need to explain all these things to the examiner as to what you're going to do with the same. Recognize the 45,05 as finance income in the SBR, and you have to recognize 51,000 in the SFP as your assets. All right, I guess this is great. We need to discuss also, this is an introductory lecture on measurement of financial assets, liabilities, what have you. We need to go now to the measurement of financial liabilities, and the question says, discuss with suitable calculations how the above financial instruments should be accounted for in the financial statements of Johnson for the year ended 31st December 20X1. Let us read together, and for our students, we're going to share this particular information on our platforms. We're told Johnson, an investment property company, adapts the fair value model, measure its investment properties. Fair value of the investment properties is highly dependent on the interest rates. The finance director of Johnson has requested your advice on accounting for the following financial instruments or financial transactions which took place during 31st December 20X1. So we go one case at a time. The first case says on 31st December X1, Johnson took out 9 million bank loan specifically to finance the purchase of some new investment properties. Fixed interest rather at the market rate of 5% is charged for the 10-year term of the loan. The transaction cost for this particular case is 150,000, and of course it was incurred. We're going to start with that one, and I hope we can be of help. Okay, so the bank loan in question is to be initially measured at fair value less transaction cost and subsequently amortized at cost. A financial liability of a 800 and supposed to be 88, yes, if I'm not mistaken, yes, 50,000 should be recognized. It's the difference between 9 million and 150. Okay. Subsequent measurement at cost entails increasing the initial liability by the effective interest rate, which is made up of 5% of the nominal loan value and 150 transaction cost. So the above effective interest rate should be charged to the statement of profit or loss for the year ended 31st December, X2. Let me just check my dates. Yes, it's 31st December X2. Why? Because we took out the loans on 31st December X1. Okay, let's progress to the next part and next discussion. The effective. Okay, so we have done that. We have read that. We now proceed to the alternative view. Alternatively, the financial liability can be measured through fair value through profit or loss to promote consistency, as the investment property being financed in this question is an asset whose gains and losses are valued through the statement of profit or loss, fair valued through profit or loss. If the fair value option is chosen, the loan will be measured at 9 million and the 150 will be charged directly to profit or loss. Any gains or losses on the loan are to be recognized in the statement of profit or loss. So I hope that we're getting something, and I hope that we can ask questions. Allow me to proceed to B, which says on 1st November 20X1, Johnson took out a speculative forward contract to buy coffee beans for delivery on 30th April 20X1, 20X2 rather, at an agreed price of 6,000, intending to settle net in cash. Now, due to surge in expected supply, a forward contract for delivery on 30th April would have cost 5,000 on 31st December 20X1. Again, you are required to discuss this particular case B. In a forward contract not held for delivery of the entity's expected physical purchase or usage requirements and not for hedging purposes is to be accounted for at fair value. At inception, the fair value of the forward contract in this case is 0. At the year end, however, the fair value is a liability of 1,000 as indicated on the next working. So the market price happens to be 5,000. That is the forward contract in December, but you are locked in a price of about 6,000. Therefore, you have got a net liability of 1,000. Therefore, you're supposed to recognize an expense of 1,000 and credit a financial liability of 1,000 as well. Great. So allow me, if you would, to go to the issue of impairment, and the question says discuss with suitable calculations the accounting treatment of the loans for the year ended 31st December X5. So in our case, impairment losses are likely to arise on financial assets, and This is what you used to have when you discussed, provision for doubtful dates issues and irrecoverable dates issues. There was basically impairment on your receivable, assets. So if you'd allow me, I want to go to the question now, and I hope I will not be stopped along the way with another question. We are told on 1st January 2025, ABC Bank made loans of 10 million to a group of customers with similar credit risk. Interest payable by the customer on these loans is LIBOR, the base rate, okay, plus 2% reset annually. On 1st January 2025, the initial present value of the expected losses over the life of the loans is expected to be 500, and of course using a discount factor of 3%. The probability of default over the next 12 months was established or estimated at 1st January 2025 to be 15%. Customers pay installments annually in arrears, and there was cash of 400 including interest which was received from customers during the year ended 31st December X5. The LIBOR rate for the year ended 31st December 2025 is the 2%, of course, plus 1.8%. After the loans were advanced, the country entered into an economic recession. By 31st December 2025, the directors now believe that there was objective evidence of impairment due to the late payment of some of the customers. Present value of the lifetime expected credit losses now stands at about 800,000. So again, LIBOR means London Interbank Offered Rate is the best rate of borrowing. You discuss again as we get back there with suitable calculations the accounting treatment of the loans for the year ended 31st December 20X5. So we're going to start bit by bit. I would like to advise that you make reference to the question. I'm going to send you this question if you're part of my students group. So on 1st January X5, the bank should recognize an allowance of about 15% of 500, which is 75% for the 12 months expected credit losses. This is a very important aspect of our discussion, and allow me just to make reference to my notes here because some of these things need to be fully understood. Okay, so the stages of credit loss recognition. Stage 1, at inception of the financial asset, initial recognition. You are supposed to recognize 12 months expected credit losses, and the calculation of effective interest rate should be applied on the gross carrying amount. Okay, and this is where we are at in this particular question. A corresponding expense should be charged of 75,000 in the SBR, and the allowance above is to be credited to the financial asset in question in the statement of financial position. Let me just correct that. And then we proceed. During the financial year 2025, an interest cost of 2250, that is 3% of 75,000, should be recognized on the brought forward allowance with a corresponding increase in the allowance to unwind 1 year discounting. So that particular 2250 should increase your allowance from 75,000 to about 1,250. Okay, I hope that you can see that. Interest revenue of 380, of course based on the base rate of 2% plus 1.8% applied on 10 million, should be recognized in the statement of profit or loss for the financial year ended 31st December 20X5. Okay, this interest is computed on the gross CV of the 10 million worth of loans. The interest of 3.8%, again I've already explained that, is a combination of 2% LIBOR plus 1.8 as given in the question. At the year end, the value of the loan note therefore will be there's a computation. We started with 10 million, then we are adding the interest, 380,000, and then we less any cash received. This gives us a CV of 9,980,000. That's the value of this particular, loans at the end of the day. Great. Now, by 31st, by 31st, let me just get back to that working there. By 31st, by 31st December 2025, owing to recession, there is an existent objective impairment evidenced by late payment by clients. We are now on stage 3 impairment loss, and if I was to get back to my work, this is objective evidence of impairment existing at the reporting dates. What we need to do is to include now the lifetime expected losses on this particular financial asset, on carrying amount net of allowance for credit losses. Please, you need to now come with me to our discussion. The revised lifetime credit losses of 800,000 requires full recognition. Remember, as the prudence concept puts it. So we're going to increase the allowance on the loans to from 77,250 to about 800, and the difference of 722,750 is to be registered in the statement of profit, or loss. Let us remember that. All right, let us proceed. So in the financial year ended 31st December, interest revenue will be calculated on the CV 31st December 20x6. Yes, interest revenue will be calculated on the CV of the loans, which will be 998 minus 800, gives us that as stage 3 impairment level has occurred. Conversely, if the loans impairment was still at stage 1 and 2, interest income and cost will be based on the gross carrying amounts of 998,000 and 800 respectively. Let us remember that. Right, so we finally get on to the issue of hedging, and I'm going to close here. As I said, this was our introductory lecture. The question on hedging says, discuss with suitable computation how the above transactions will be accounted for in the financial statements for the year ended 31st December 2021 and on the date of settlement. If you'd allow me, I'll go ahead of you to read. One Air is a successful international airline. A key factor affecting One Air's cash flows and profits is its operational cost on jet fuel, on the cost of jet fuel. On 1st October 2021, One Air therefore entered into a forward contract to hedge its expected fuel requirement for the second quarter of 2022 for delivery of 28 million gallons of jet fuel on 31st March 2022 at a price of $2.04. Is it $2.04 per gallon? The airline intended to settle the contract net in cash and purchase the actual required quantity of jet fuel in the open market on 31st March 20x8. At the company's year end, the forward price for delivery on 31st March 20x2 has risen to $2.16 per gallon of fuel. All necessary documentation was set up at inception for the contract to be accounted for as a hedge. You should assume that the hedge was fully effective. On the 1st March, the company settled the forward contract net in cash and purchased 30 million gallons of jet fuel at the spot price of $2.19. Again, the question says, discuss, going there, suitable computation of how the above transaction would be accounted for in the FS of the company. I'd like to encourage you to make reference to the question as I discuss. Okay, and we are going to close just now, about 4 slides. One is hedging exposure of future fuel purchase using a cash flow hedging instrument. At inception, we proceed therefore as follows. We have got a market price forward contract based on the 28 million gallons of that match, and is valued at 60.48 million. But the forward contract would mean that would only buy that at 57.7. Therefore, there's a saving. Our liabilities is reduced by 3.36 million. So essentially, what we have is a forward contract asset of that number, which can be, recognized in other comprehensive income. Now, the purchase of 30 million gallons of fuel gives rise to a cost of sales of 65.70 million. I should have written million there so that we can understand where we're coming from. Yes, dollars. At this point, the contract is settled net in cash, but we are also aware that yes, in the following year there's a change. The market price now goes to $2.19 per gallon, and that gives us a price of about 61.32. But since we have got a forward contract of at 2.04 dollars, we're still able to make more savings. This time around, the saving appears to be more of 4.2. So what we shall see there is that there's going to be a net cash settlement of that match, and which will be debited, of course, to our cash, and then we credit forward contract OCI at that match, and then the SBO will receive the difference of 0.84 million. Okay. The gain of 4.20 million compensates the cost of increase in fuel. The gain of 3.36 initially, measured in OCI, can still be recycled to SBR, since we are dealing with, inventory. The overall effect of this particular hedge, and it is effective, is to reduce our, cost of jet fuel from 67.5 million to 61.50 million when you less the 4.20 from the 67.5 million. So I'd like to thank you for listening, and let me know if you have got some questions. Otherwise, let us keep in touch. Thank you very much for your attention.